In this video, we're going to be looking at some policies from this year's budget that were specifically designed to increase the level of national savings, as well as do a bit of a recap of the last video. So, in the last video, we talked about how more contractionary policies and more contractionary budgets can lead to reduced import spending and help to reduce public sector debt and reduce the interest on that debt. That is all both true, but the problem with this theory is that often when public sector debt decreases through contractionary policies, that can lead to increased private sector investment and private sector debt. And there's two reasons for this. One, when the government employs contractionary policies, this may come about through higher taxes. When we tax consumers more, it essentially reduces their disposable income and makes it harder for them to save. So, for example, if taxes increase by the equivalent to $100, people may have $100 less that they can put into their banks to save. This often leads to more people having to go into debt or borrow to try and fuel their consumption spending, and leads to an increase in private sector debt and a decrease in private sector savings. So higher taxes as a result of contractionary policies can lead to less private sector savings and more private sector debt. The other thing is that budget surpluses generally lead to lower interest rates because of the impact of crowding in. So now that the banks are becoming now that the government has become a net lender to the banks are more liquid and have more liquidity, and therefore are able to lend to people at lower interest rates. So the lower interest rates due to crowding in basically encourages the private sector to borrow. There should be a borrow at the end of that too. So because of the lower interest rates, not only are consumers more likely to borrow, but firms are more likely to invest, and that can lead again to an increase in private sector borrowings and therefore jeopardise the goal of external stability. So the CAD still can increase when public sector debt decreases because of the private sector borrowing more, because of potentially higher taxes and lower interest rates. Overall, budget surpluses should help to reduce the current account deficit and reduce the total level of net foreign debt, but this is just one weakness of running contractionary policies. This happened back from 1996 to 2007. The government removed their portion of net foreign debt by running surpluses, but private sector debt actually increased. So just to summarise, the pros for surpluses and external stability. It reduces the government section of net foreign debt and therefore reduces the amount of interest they have to pay on that debt, helping to reduce the net primary income deficit. It can reduce the balance of merchandise trade deficit of the CAD because of lower import spending, because of contractionary policies. Budget surpluses also help to improve our credit rating and keep interest rates low on borrowed funds, and can also improve confidence in the dollar because the economy is showing an ability to pay back its debt. On the negative side, private investment often increases because of lower interest rates when we run surpluses, because of the crowding in effect. The government can't really solve the private sector part of net foreign debt. They can only look at their net foreign debt. And thirdly, increased taxes reduce private savings due to less disposable income. So if we increase taxes to run a surplus, that can help to reduce public sector debt, but it can lead to more private sector debt because people are forced to spend and people are forced to borrow to fuel their spending because they have a lower disposable income. Policies from this year's budget that should help us to push us back into surplus and reduce public sector debt. Taxing the multinationals at the higher rate of 40% if they're dodgy and try and shift their revenue offshore will help to get the government back to surplus, budget back to surplus. The freeze on Medicare will again help to reduce the government's costs associated with providing Medicare, and therefore that will help to increase the size of the surplus or reduce the deficit. The excise tax on tobacco, again looking at trying to boost government revenue. And changes to the superannuation will make it harder for high income earners to take advantage of tax concessions, so the government will be claiming more tax on high income earners' superannuation contributions, again helping to push us back into surplus. From a couple of previous years' budgets, back in 2013, 2014, the government increased the amount that people had to pay in the superannuation, so it was called raising the superannuation guarantee, which basically meant instead of putting 9% of our money into super, we put up to 12%. Or employers were forced to put up to 12% of our income into superannuation. That boosted national savings and reduced import spending in the short term. It also meant that more pensioners had savings for retirement, which will reduce the pressure on the government to provide pensions in the future and help to reduce the size of our future deficits. So again, there's less current spending on imports, which reduces the gap between investments and savings, and in the long term, the government's got more money to provide other services because they're spending less on pensions, which helps keep the budget in surplus. That's basically what they've done with super. As you can see, 25 years ago, super was only 3 to 4%. Currently, it's 9.5%, and it's predicted to go up to 12% after 2021. Just to finish off, just one question. How can an increase in public sector savings lead to a reduction in private sector savings? When the government increases its savings, it generally does this by increasing taxes and reducing expenditure. This can lead to, so they might reduce family payments or reduce welfare for people. This basically means that people will have to spend more to cover the shortfall. So the increase in taxation revenue will basically mean that people will be more likely to go into debt, and therefore that's going to lead to more private sector debt.